It rose by 300% in just 15 months. Then, in only 2 days, hundreds of thousands of accounts were wiped out. The government held an emergency meeting and opened suicide prevention hotlines. Yet the chart is still going up. This isn't a single stock. It's a country's main stock market index. How can a market that looks this powerful while rising, at the same time, destroy so many people? The answer lies where most people never look. If this video found you, don't see it as a coincidence. What we talk about here are subjects most people deliberately choose to stay away from. If you still haven't subscribed, you probably just find this interesting. But there's a huge difference between finding something interesting and actually understanding it. Subscribe. Our topic is the South Korean stock market, and specifically the KOSPI index. It is currently one of the largest stock markets in the world, with a total market capitalization of around $3.8 trillion. But what really matters here is not its size, it is its structure. Because nearly half of this index belongs to just 2 companies. One of them is probably somewhere inside the phone in your pocket, the television in your home, or many of the electronic devices you use every day. Samsung Electronics. One of the world's largest technology manufacturers, Samsung operates across a remarkably wide range of industries, from semiconductor technology and displays to home appliances and mobile devices. The other is a less familiar name, but one that is just as critical: SK Hynix. The company produces memory modules, the components that provide the memory inside computers, servers, and smartphones. It has become one of the world's most important producers of high-performance memory chips, particularly the kind required by artificial intelligence systems. As demand for this technology exploded, its market value even surpassed Samsung's for a period of time. Think of it this way. Imagine a team with more than 900 players, where 2 players are effectively carrying the entire game on their own. When they play well, the team wins. But when they get injured or lose form, the entire scoreboard suddenly starts to shake. That is essentially how the KOSPI works. Whether it is rising or falling, the index moves largely under the shadow of these 2 companies. On June 18, 2026, carried by these 2 companies, the index crossed 9,000 points for the first time in its history. Just 1 year earlier, these 2 companies accounted for roughly a quarter of the index. Today, that share has grown to nearly half. The fundamental reason behind this shift is the explosion in global demand for AI hardware. Companies around the world are lining up for the specialized memory chips needed to run artificial intelligence models, and 2 of the companies producing a huge portion of these chips are based in South Korea. In other words, at least in the beginning, the rise of the KOSPI was not simply a wave of abstract speculation. It was the reflection of real global demand and a concrete technological need. The combined market value of these 2 companies is approaching the annual economic output of many mid-sized countries. So what we are talking about here is not simply the story of 2 giant companies. It is the story of one of the most critical links in the global technology supply chain. Let's go back to the question we asked at the beginning. How were these bankruptcies possible while the chart was still going up? To find the answer, let's start with the numbers. The rally that began a year ago is still in positive territory, despite the decline over the past month. So, to someone looking only at the price chart, there doesn't appear to be a major crisis. But that is not the real picture. On July 28th and 29th, 2026, the stock market triggered what is known as a circuit breaker, an automatic mechanism designed to halt trading temporarily. On 2 consecutive days. It was the first time anything like this had happened in the index's decades-long history. Over those 2 days, the index lost as much as 16%. Since its June peak, the decline had exceeded 30%, and at this point, nearly 1 million individual accounts received margin calls. Hundreds of thousands were completely wiped out. Let's make this a little more concrete. A circuit breaker is a safety mechanism that effectively tells the stock market to stop by temporarily halting trading. Even triggering one is a rare event, perhaps happening only once in a typical year. Triggering it on 2 consecutive days had never happened before in this market's history. At the same time, the local currency was also losing value, even though the country was running a significant trade surplus. That was an important sign that the problem was not limited to stock prices alone. Still, there is an important counterpoint. Since the beginning of the year, the same stock market remains one of the best performing major indexes in the world. So what are we really looking at here? A complete collapse? Or simply a brutal correction after an exceptionally rapid rise? Or is there a deeper structural crack underneath it all? Similar sharp corrections have occasionally hit AI-related stocks on other markets around the world as well. What makes this case unusual is the scale and speed of the correction. And to understand why, we need to move into a more technical concept: leverage. Because the real earthquake is not hidden in the prices themselves. It is hidden beneath the bets that were magnified with borrowed money. So what exactly do we mean by margin or leverage? In simple terms, borrowing money to make a position much larger than the amount of money you actually have. You have 1 unit. Your broker gives you 4 more. You open a position worth 5 units in total. From that point on, both your gains and your losses are calculated on the full 5 units. But the losses come directly out of your original 1 unit. Think of leverage as an elevator that takes you upward very quickly. But when it comes down, it moves just as fast. And at the end of that cable, there is more money attached than you actually own. You enjoy the ride as the elevator goes up, but when it comes down, it is not just your own weight on your shoulders. The weight of the entire elevator comes down with you, and that extra weight makes the impact when you hit the ground even harder. Let's look at the numbers, because this is where staying abstract can become dangerous. With 5 times leverage, a market decline of just 20% is enough to wipe out your capital. With 4 times leverage, that threshold rises to 25%, and with 3 times leverage, a 33% decline is enough. In other words, the higher the leverage, the smaller the market move needed to wipe you out. The market does not need to experience a massive crash. Even a small but rapid pullback can be enough. Many people only understand this after they experience it themselves. What makes things even more dangerous is the behavioral side. As the market rises, your account grows. You stop opening new positions based on the amount you originally invested and start sizing them according to your inflated balance at that moment. Let's take an example. Someone who starts with 100 units and uses 5 times leverage can see their equity grow to 350 units after the market rises by 50%. If they then rebuild their position using the same proportion, they are now carrying more than 3 times the risk they had at the beginning. And when the market turns from the peak, the reversal can be just as brutal. This touches one of the weakest points in human psychology. The more you win, the stronger the feeling becomes that you are doing everything right. And as the risk grows, so does our tendency to underestimate it. People usually ask, "How much have I made?" They rarely ask, "How much can I lose?" As the potential gains grow, the possibility of loss becomes smaller in our minds. This is a classic cognitive bias, and that is essentially what happened in the KOSPI. While the index was still up compared with the beginning of the year, hundreds of thousands of accounts that had entered with leverage near the top were wiped out because many investors assumed the rally would continue and kept increasing the size of their positions. Just a little more meant just a little more risk, and when enough of those little mores accumulated, the reversal turned into a disaster. Small decisions produced enormous consequences. Then in May 2026, things became even more complicated. Leveraged ETFs were introduced to the market, exchange-traded funds designed to track a single stock with 2 times leverage. Investors could also buy these products using borrowed money. So on top of the product's built-in 2 times leverage, another layer of leverage was added through margin borrowing. The resulting effective leverage could sometimes reach 4 times or even higher. That significantly increased the fragility of the system. Now it was no longer just individual accounts pushing in the same direction. The funds were doing it too. When individual investors and institutional products make the same mistake at the same time, the impact multiplies. The largest leveraged product tracking SK Hynix lost more than 80% between its June peak and the end of July, and this happened even though the company reported record profits during the same period. A similar fund tracking Samsung fell by roughly 75%. Pay attention to what happened here. The companies themselves were performing well, while the leveraged products tracking them were being destroyed. This makes one thing very clear. The problem was not a bad company, it was a bad vehicle. This was the moment when the underlying reality and the financial instrument became disconnected. The problem was not specific to a single company. It was a vulnerability spread throughout the entire system because the two stocks that make up nearly half of the index were simultaneously under intense pressure, both directly and through leveraged products. And there is one little-known but critical detail about these products. Their leverage ratio resets every single day. The product is designed to deliver twice the daily return, not twice the cumulative return from the previous day's gain or loss. And that creates a mathematical form of erosion in a volatile market. Let's use a simple example. Suppose a stock falls 10% one day and then rises 10% the next. The normal stock ends up almost back where it started, but a 2 times leveraged product first loses 20%, then gains 20% on its remaining balance. The result is still below where it started. Let's look at the numbers more clearly. You start with 100 units. Day 1, the stock falls 10% to the 2 times product loses 20% to 80 units remain. Day 2, the stock rises 10% implies the 2 times product gains 20% implies 80 times 1.20 equals 96 units. While the normal stock has nearly returned to its starting point, the leveraged product is still down 4%. That difference may look small, but as volatility increases and more days pass, it compounds. This is known as volatility decay, and it is something many investors overlook. People buy these products thinking they are getting 2 times the returns. What they are also getting is 2 times the volatility, and volatility can quietly eat away at their capital over the long term. These products can work relatively well in calm directional markets, but during the volatile periods when investors need them most, they can lose far more than expected. And then we come to the real mechanical problem. These funds have to maintain their target leverage ratio on a daily basis. When the price falls, the fund has to sell shares to maintain that ratio. Those sales push the price even lower, and when the price falls again, the fund has to sell again. A small decline can turn into a self-reinforcing spiral, and once that spiral gains momentum, it becomes increasingly difficult to stop because the side that is forced to sell has to trade regardless of the price. So fewer people are saying, "It's cheap, I'll buy," and more people are saying, "I have to sell." The market is no longer discovering prices, it is discovering forced selling. After circuit breakers were triggered on 2 consecutive days, regulators stepped in and halted the listing of new leveraged products tracking individual stocks. The self-reinforcing mechanism was, at least for now, brought under control for new products. There is an important distinction to make here. With leverage trading in markets such as Forex, there's usually a safety net. Before your balance falls below zero, the position is automatically closed. You lose only what you deposited, but margin trading in stocks can work differently. The broker has actually purchased the shares from the market on your behalf. Because those shares are an asset held on your behalf, any shortfall created when the price falls can remain your responsibility. For example, suppose you're holding 10 units worth of stock on margin and 8 units of that value are borrowed money. If the stock falls 40%, the total value drops to 6 units, but the debt is still 8 units. So you're not only losing your own 2 units, you are left with an additional 2 units of debt. This invalidates one of the assumptions many investors have. At worst, I'll lose my money, because the worst case scenario can be losing your money and still ending up in debt. And that debt does not simply remain on paper. The broker can pursue repayment. Your losses are no longer limited to the money you originally invested. The process works like this. Your margin ratio falls below the required threshold. The broker issues a margin call, asking you to provide additional collateral. If you cannot meet it, the broker can automatically sell your positions on your behalf, even without your approval. When thousands of accounts trigger these automatic sales at the same time, the number of sellers can overwhelm the buyers in the market. The decline becomes much faster and more severe than it otherwise would have been. Because these sales are involuntary, they are forced. Prices fall, which creates more forced selling. More forced selling creates even lower prices. And once this cycle begins, it can start feeding itself. Human choice is pushed out of the equation. The system begins crushing itself. In the past, these processes could take days. People would call each other, try to make decisions, and perhaps search for additional collateral. Today, automated systems can complete the same process within hours or even minutes. Technology has accelerated both the rise and the fall. By reducing the human element, it has also made panic more mechanical. Speed amplified both the profits and the disaster. And in this market, a large share of trading is not driven by institutional funds. It is driven by individual investors. A significant portion of the population, millions of people, trade directly in the stock market. That makes the market more sensitive in both directions. When prices rise, optimism can spread rapidly. When prices fall and the same crowd rushes for the exit at once, prices can collapse much faster. In markets dominated by institutional investors, decisions are generally made more slowly and with greater discipline. Here, decisions were fast, emotional, and collective. One person selling could trigger another person to sell. Social media and group chats amplified the effect even further. What was spreading was not information, it was emotion. But were the people making these trades simply uninformed? No. Many were well-educated, numerically minded, and young, often in their 20s and 30s. So why were they willing to take such enormous risks? The answer is familiar. Housing prices had become disconnected from wages. Traditional ways of building wealth no longer seemed sufficient. For many young people, goals such as owning a home or starting a family were becoming increasingly difficult to achieve through conventional means. A high-risk shortcut, even if the odds were low, could begin to look like the only realistic option. When hope becomes mixed with risk, mathematics gets pushed into the background. Then there are the success stories on social media. The winners speak loudly while the losers remain silent. Because people see only the winners, they perceive the risk-reward balance as far more attractive than it really is. In behavioral economics, this is known as survivorship bias, and its effect is stronger than we tend to realize. The stories of those who lost are rarely told. The stories of those who won are repeated again and again. The result? Our perception of risk becomes distorted. People think, I can do it too, while ignoring the possibility that I could lose too. There is another factor. The longer a rally continues, the more people's perception of risk begins to fade. The idea that this time is different starts to spread. But mathematically, the higher the leverage, the greater the potential for even a small reversal to become devastating. Long bull markets can lead people into the illusion that a decline simply will not happen. But declines always happen. The question is, when and how severe they will be. And leverage makes the answer to that second question much more painful. One final point. The stock market's rally over the past 15 months was one of the strongest bull markets it had experienced since the 1980s. So this was not simply a bubble that inflated overnight. It can also be understood as the natural result of a long and powerful rise. There was real demand. There were real profits. There was a real technology story behind it. But the layers of leverage built on top of that story made both the rise and the fall far more extreme than they naturally should have been. In other words, the problem was not the story itself. It was how much debt people used to ride that story. The story was real. The instrument was wrong. And the wrong instrument can turn even a correct story into something destructive. After the crisis, something unusual happened. The head of the regulatory body responsible for approving these products publicly apologized. New rules followed. Individual investors who wanted to purchase leveraged products were required to complete risk education and meet additional collateral requirements. And despite all the losses that occurred, this stock market still ranks among the strongest performing major markets in the world since the beginning of the year. So what we are looking at is not simply a collapse. It is the painful but familiar price of growth that happened too quickly. The chart may still be pointing upward over the long term, but the question of who is standing underneath that chart and how much debt they are carrying has now become far more important. So what is the lesson we should take away from all of this? Leverage may look like it magnifies your returns, but what it actually does is something different. It shortens the amount of time you have to be right. For an investor without leverage, a 30% correction may simply be a period of volatility that can be endured with patience. But for a leveraged investor, that same correction can mean the complete destruction of the account. So the real difference is not return, it is the ability to survive time. The true strength of a position is not measured by how much it can make. It is measured by how much of a bad day it can survive. There is a practical lesson here. Whenever you make an investment decision, ask yourself one simple question. If this position moves 20 or 30% against me, what will I have left? If the answer is nothingness or debt, then the position is far larger than your actual risk tolerance. Asking this question is one of the most basic filters that many people overlook, and we can take this one step further. It is not enough to look only at the leverage ratio. You also need to ask, if this position moves against me, how many days or weeks can I survive? Because as we have seen, the truly destructive force is not necessarily a single bad day. It is the chain reaction created when forced selling feeds into more forced selling. Your ability to withstand time can become more important than the leverage ratio itself. A position that gives you time can survive far greater volatility than an equally sized leveraged position. Time is one of the most powerful tools in risk management, but leverage takes time away from you. Here is one small habit that can actually help. Next to every investment decision, write down your leverage ratio and the percentage decline that would wipe out your position. When you see the number written down, you may notice that it looks far more frightening than it sounded in your head. This small habit can stop many impulsive, high-risk positions before they even begin. Writing makes risk tangible, and once risk becomes tangible, it becomes much less attractive. Now let's go back to that chart from the beginning. That reassuring curve that was still pointing upward. That is exactly why it was misleading. A price curve by itself tells you almost nothing. The real story is hidden underneath it. Who was riding that curve, and how much debt were they carrying? The same 300% rise can still represent an enormous gain for someone investing their own money. For someone using leverage, the same rise can be followed by a devastating loss. The chart is identical for both, but the story is completely different. The price looks the same to everyone. The outcome does not. No matter how real a market's rise may be, and here there really were real profits and real growth from real companies, how you ride the rise determines what you lose on the way down. The right story plus the wrong instrument equals destruction. That formula has repeated itself again and again. And there is one more thing to add. This lesson is not limited to the stock market. A purchase amplified by credit card debt, a property bought with borrowed money, a business investment expanded through debt. They all follow the same mathematics. Wherever leverage is used, it does the same thing. It magnifies the potential gain while also accelerating the potential loss. And speed is often unforgiving. That is why the logic we have explored in this video can be applied not only to stocks, but to any decision you make that is amplified by debt. The question is always the same. If this decision goes wrong, how long can I survive? If the answer is unclear, the risk is probably too high. And finally, remember this. Markets can continue to rise. Companies can continue to grow. The stories can remain true. But leverage can turn even something that is fundamentally right into something that is wrong for you. The real protection is not how smart you are. It is how long you can stay standing. Today, we didn't just talk about one event. We talked about a mechanism. No one lied. No number was fake. Debt simply accumulated quietly, and mathematics did what it always does. It punished those who ran out of patience, but that is not the most dangerous part. The truly dangerous part is that this same system may still be operating in other markets under different names right now. So here is my question for you. Which green chart do you think is the most dangerous right now? Tell us in the comments. We'll take the answer that comes up most often and put it under the microscope in the next video. Some ideas are simply too big to fit into a single video. There are topics we are already working on that we haven't revealed yet. In the next video, we'll explore one of them together. Subscribe, turn on notifications, and be among the first to see what's really happening.